പാടുന്നു പ്രിയരാഗങ്ങൾ ചിരിമായാതെ നഗരം തേടുന്നു പുതുതീരങ്ങൾ കൊതി തീരാതെ ഹൃദയം കണ്ണെത്താ ദൂരത്തെ കൺചിമ്മും ദീപങ്ങൾ നാം കണ്ട സ്വപ്നങ്ങൾ പോ ശിലാതലം മഴ പോൽ പുണർന്നു നിൻ ഓരോ മൗനങ്ങളും പകലിൻ വരാന്തയിൽ വെയിലായി അലഞ്ഞിതാ തമ്മിൽ ചേരുന്നു നാം തലോടുമിന്നലകൾ കുളിരോർമ തൻ വിരലാൽ തുടരുന്നു സഹയാത്രയിൽ
On behalf of ECHO, we welcome you for this tax seminar here. I know it's a comprehensive, it's very interesting subjects here, and we have we have 3 sessions here. The first part will be it's like a retirement planning and asset protection planning, which will be Susan Napatol and Goodman will be taking care of that, and Sabu Lucas also will be assisting with her, and she is a well-known attorney and she is practicing on that division. And the second session will Vinod George and Babu Uthaman will be taking care of. They will be speaking about the tax cuts and tax acts, foreign asset reporting, income gifts, and personal tax planning. I know that we have a lot of things in the plate, and you are excited. And being said that, I invite Sabu Lucas to onto the stage, and Susan will be taking care from here.
Once again, I would like to welcome everyone for this exciting seminar program today. So last several years, our ECHO is doing this type of seminar for our public. Some people are using that opportunity, some people are not using, but we are expecting more people to use this opportunity to talk with top people like attorney and our CPA people. That is the way you can learn how you can prepare for your future in this country. So in America, everything is a planning. That is the most important thing. If you don't plan anything, you cannot success in anything. Even in our life, in our economical way, in our social way, we need to have a planning. That is why ECHO is giving a more importance for this type of seminar. That is the way we can educate our community. You can be a successful part of this American situation. So here, let me introduce one more time Suzanne. She is an attorney last 30 years, and we have a very professional organization that's known as Blue Ocean Wealth Solution. Almost 250 people are working there as advisors, and she is one of the pioneer lawyer in advanced market and retirement planning and elder law. That is the main practice. She's one of the speaker for the AKMG meeting, and she's a well-known. She only doesn't like a spicy food. She like everything else. So it is our honor and privilege she's to be here, because the reason is today is Sunday, she off day, but I request very humble way. That's why even though she cannot drive, she get a chance to come over here because she show her connection to our community. That is why we really appreciate your presence here. So I would like to welcome Suzanne without any delay. She can present whatever the presentation today regarding to LLA and asset protection and our retirement planning. Thank you.
Okay, so today I'm going to talk to you a little bit about elder law. We're going to get into some trusts, and we're going to talk about what we can do to protect ourselves and our assets and our families from having our assets totally depleted in the event that something should happen to us and we might need long-term care. Okay? I'll pass by the disclaimer. That just says that, you know, Mass Mutual is not responsible, ... Okay? Okay. So in this session, I'd like to talk a little bit about estate planning, and then I'm going to talk to you about long-term care planning. Okay, so let's start with the basics. For estate planning, how many people here have wills? Okay, some, not all. Most don't. That's not uncommon. We do find that a lot, that a lot of people do not have wills. But do you know that you don't get to control where your assets go if you don't have a will? New York State law controls where they go, and it may not be where you want it to go. So it would behoove everyone to make sure that they go back and have a will executed. Okay, it's not that difficult of a process, but you do need to get it done. Okay, so now let's talk a little bit about wills. It basically is your written plan to tell someone else what you want done with your assets. Okay, now, most people think that everything automatically goes to their surviving spouse. That is not the case under New York law. If you do not have a will and you have assets in your own name, your spouse only gets the first $50,000, and then after that, she only gets 1/2 of the remaining balance. The kids get the other half. If that's not what you intend to have happen, then you need to have a will to correct that. A couple of other things. I notice we have some kids here. They're under the age of 18. If you do not have a will, you do not have a guardian appointed for your children. And should you pass away without a will and without a guardian named in that will, the court will decide where your kids go. I don't know about you, but I'm one of 7 kids, and certain of my siblings don't parent the same way I did. Now, I don't have to worry about that anymore. My youngest is 21, so I don't have to worry. But prior to them turning 18, the court would decide where they go. So here's the first thing that would happen. Both sets of grandparents would argue over who would be the better grandparent and the better guardian. So now the kids are embroiled in that battle. And if that doesn't work, then one of your siblings may do it. Well, I have so most of my siblings live in Massachusetts. I wouldn't want my kids removed from New York. So in order to preclude that from happening, I coordinated with one of my siblings who lives here in New York, and she was going to be the guardian of my kids. As I said, my kids are older now, so I don't need a guardian any longer in my will. So even though it's in my will, that provision just won't be executed. Wills have to meet formal execution procedures. You can't just sign your will. You have to have witnesses under New York law. They have to be disinterested witnesses. In other words, they can't be a beneficiary under the will, and they can't be related to you by blood or marriage. A lot of times I see wills executed, and well, it was my brother-in-law who witnessed my signature. That's not acceptable under New York law. In addition, you have to know that holographic wills or handwritten wills are not accepted in New York unless you're a mariner at sea or in active combat, okay? Well, our military isn't in active combat right now for the most part. So any military person, if they executed their will and they're here in the States, that's not active combat. You have to have it formally done, it has to be typewritten, and you have to have the proper execution procedures done. A revocable trust, which a lot of you hear about. And there's a lot of attorneys out there who do all kinds of seminars on revocable trusts. Just to let you know, a revocable trust does not divest you of assets. It just controls the distribution of your assets upon your demise. So for example, if you created a revocable trust, it would do the same thing that a will would do, except it does avoid probate. If you have real estate in different states, you definitely want to avoid probate. It's not that scary of a process, but when you have real estate in several states, say you have property in Florida, what happens is you've got to do one probate here, and you have to do a second, known as an ancillary probate, in Florida. You don't want to have to go through two. It just dries up your costs. So you don't want to have to do that. So the revocable trust removes the assets from the surrogate court. If you think that you're going to have a will contest, in other words, if you're not treating your kids equally, and you think there's going to be a contest as to your competence when you executed the will, do a revocable trust. That removes the contest, because contests occur in the surrogate court, where you probate the will. If you don't have a probate, you won't have the contest. Okay, so now, revocable trust will definitely allow you during your lifetime to avoid any kind of hiccup should you become incompetent, because the alternate trustee just steps in and takes care of everything. If you don't have a revocable trust, it's not an issue, but we need to create a general power of attorney, and we'll get to that in a few minutes. Okay, now, the living will, that's the death with dignity. Okay, it's a basic, I call it an ancillary document. Whenever anybody comes to have a will drawn up or a revocable trust drawn up, they need to make sure that they have these ancillary documents as well. The living will is the proverbial pulling of the plug. If you are unconscious or incompetent and cannot make the decision for yourself, you need to appoint someone to act on your behalf for medical reasons. So that involves both the healthcare proxy and the living will. The healthcare proxy is much broader than the living will. It is statutory in New York State, but it will allow someone to act on your behalf to withhold extraordinary measures. In other words, don't hook me up to the feeding tube if I am terminal with no chance of recovery. Okay? If we break our leg, like I did, I keep telling my kids, you can't pull the plug on me, I'm sorry. Okay? But if I am terminal with no chance of recovery, then it's time for the health proxy to come into play. And again, if you are conscious and competent, you can tell the doctor, don't put me on the feeding tube. I don't want the nutrition and hydration. I know it's going to speed my death up, but don't put me on there. I've got no chance of recovery, and I do not want to live like a vegetable in a nursing home. If most times you're not conscious and competent, however, so someone needs to be able to make that decision for you. The living will solidifies that with respect to the life support system. Now, if you tell me you have a health proxy and you don't have a living will, that's okay. That's okay. As long as you have the health proxy, your donee will be able to make a decision for you. There's different types of health proxies out there. New York State has a form on their website that you can just say, okay, I give John Jones the power to make decisions on my behalf. But it doesn't tell John Jones what you expect. I don't particularly like those types of powers because they're too open-ended, and you may have different opinions on when to pull the plug and when not to pull the plug. In addition to that, let's say you give it to your oldest child. Okay, spouse is no longer available for this, so now we have the oldest child as the appointee. You don't want the siblings coming to them saying, you pulled the plug on mom or dad. You killed them. You want to make sure that your document specifies, if I am terminal with no chance of recovery, do not put me on life support systems, including the nutrition and hydration and the respirator. If you put it clearly in the health proxy document, then your child is never, the donee of that power is never going to have the issue that this is not what mom and dad wanted. She put it in, or he put it in writing. That also has to be witnessed by two witnesses not related by blood or marriage. Okay? Try to get these documents done. If you know that you're going to have a surgery coming up or something, please try to get them done ahead of time. The hospital does not need the original. Make a copy of it. I even go as far as, because most hospitals now use a binder for your chart, I put a 3-hole punch in it so they can just stick it right in the binder. Okay? Do that for yourself. They don't need the original. If the original goes to the hospital, you will never see it again. So you really don't want to do that. Okay? Very, very important documents. The last ancillary document is the general power of attorney. It is very important to have a general power of attorney. If you get injured in any way, or you just can't handle your financial affairs for whatever reason, someone can act on your behalf. Now, New York State is very explicit with their power of attorney. Years ago, and I'm talking years ago, it's almost 10 years ago now, New York State changed the law. Most attorneys were drafting a power of attorney that was explicit, but it was on a single sheet of paper. They felt that the consumers of New York didn't understand what they were signing. So they changed the law, they made it more specific and made it a 10-page document. Made it easier for us to understand, right? Well, they did change the law in several respects, and people who have executed their powers of attorney before that point need to re-execute their powers of attorney. The new powers of attorney would allow several things to happen that the old ones didn't. The old ones did not allow the donee of that power to make a gift to themselves. So you would not be able, so under the old power of attorney, if I had power of attorney, say for my mom, I couldn't make a gift to myself, even if it was going to help her for Medicaid planning. I couldn't do it. The new powers of attorney will allow that. In addition, the new powers of attorney, if you don't have what's called a statutory major gifts rider, they do not allow you to make a gift of more than $500 per year. That's not per donee, that's per year. So you really need to execute and re-execute your powers of attorney. They're much broader these days, and the statutory major gifts rider is imperative, especially if you have to do last-minute Medicaid planning. If you don't have that gift rider, and you have all your assets in your name, and all of a sudden you're faced with the burden of having to qualify for Medicaid, for either home health care or nursing home care, your donee of the power of attorney is not going to be able to help you without the gift rider. So it's imperative that if you did not execute it, get one executed. If you did execute it, but it was before 2009, and again they modified it in 2012, re-execute those documents. Okay, let's talk about long-term care. Okay, long-term care is not the same thing as Medicare. Medicare is your hospitalization, your doctor's bills. That's separate. Once you get to the point where you're no longer in a position to take care of yourself, you can't bathe yourself, you can't dress yourself, you can't feed yourself, any normal activities of daily living, when you get to that point, now you've flipped over to chronic care or long-term care. And there's several things that can be done to protect your assets. Because if it was up to the state of New York, you would pay for your own care until your family has nothing. Okay, so you really need to think about this planning while you still can. Okay, you don't want to wait too long. What Medicaid does is they split your assets into income assets and resource assets. There's also some exempt assets. So let me give you an example of an exempt asset. Your primary residence, as long as your spouse lives at home, is an exempt asset. But if your spouse passes away, guess what now becomes available for Medicaid? Your primary residence. There are other exempt assets, one car, a Bible, personal property. Those are exempt assets. As far as income assets go, income assets would be Social Security, your pension, and your retirement assets. Medicaid only considers the income that you receive, the required minimum distribution, from your retirement asset. They do not force you to liquidate your IRA to pay for the nursing home. I've had many people come to me and I'm like, whoa, who told you to liquidate your IRA? Don't do that. You don't have to. You just have to take a distribution. One thing to be aware of though, the IRS chart for required minimum distributions and Medicaid's chart for required minimum distributions are not the same charts. The IRS chart gives you a lower divisor, which in effect allows your, a higher divisor rather, which allows your IRA to last for a longer period of time. Okay, but don't be alarmed at that, because if you should pass away while on Medicaid, the IRA has a beneficiary designation. The beneficiary gets the assets. So far in New York State, Medicaid can only come after probate assets. So remember when I talked about that revocable trust? If you have a Medicaid situation, a revocable trust is not a bad thing, because it takes all of your assets out of the jurisdiction of the surrogate court, and you no longer have a probate estate. Medicaid has no place to place a claim. Now, let's talk about your resource assets. I think I updated this to add, yes, this is the 2019 limits. Now, let me just interject here. Medicaid will pay for home health care or nursing home care, and the limits are totally different. For home health care, your income as a single person can be $859. For a married couple, you can have $1,267. So many times people come to me and say, my income is over that. My Social Security alone is $15,000. How can I qualify for home health care? You can. What happens is you execute, not only you apply for Medicaid, but then you also have to sign into what's called a community trust or a pooled income trust. Any of your income in excess of those figures would go into that trust. When you get your bill, because we all know our real estate taxes are ridiculously high here on Long Island and in the city. So when we receive our bills, we submit the bill to the community trust and say this bill is due. They'll either give you the money, depends on the trust you're in, or they'll pay the bill directly. So you can get your income back to pay your bills. However, should you pass away and your account has excess income in there, your family will never get the excess income back. That goes to the other members of the community who belong to that trust. In the same token, if your bills are $2,000 this month and your income was only $1,500, you get to use somebody else's money to pay your extra $500 in bills. So it's kind of a give and take for the home health care. Home health care, just so that you know, they treat resources differently. It's usually, most attorneys say it's like a 30-day look back. They like you to dispose of your assets. We'll talk about how you can do that. Wait 30 days and then apply for Medicaid. The other thing you have to be aware of with home health care is they send someone to evaluate you to determine how many hours you need. You may think you need 24-hour care. They may say, no, you only need 10 hours care. So it's kind of a give and take. So your assets may have to be used to pay for additional care should you need it. Okay? let's just talk about the income limit for nursing home care. That's the chronic care Medicaid application. So with the chronic care application, your income, if you are going to be the institutionalized spouse, is only allowed to be $50. If you are the community spouse, who is the one who's still at home, your income can be $3,100 and change. If the community spouse only has $1,000 in income, we can take from the institutionalized spouse to bring them up to the $3,000 level, but we can't go over that. Okay, so as you can see, some of you, I don't know what your bills are. These are all per month, by the way. I don't know what your bills are, but if your bills exceed that $3,000 per month, we have to figure out where your spouse is going to get the extra money to pay for the bills, just to live. Okay, let's talk about resources. Because the resources, oops, sorry about that. The resources are also different for nursing home spouse versus community spouse. Okay, so for the nursing home spouse, you're allowed to have $15,450. Okay, for the home health care person applying for Medicaid, you may have $15,450. If both are applying for Medicaid, it's $22,000 and change. That's the total amount of resources. Now remember, that excludes the house, and it excludes your retirement assets because they are income assets, not resource assets. But all of your bank accounts, your stocks and bonds, all of those are considered resources. Okay? For the community spouse in a nursing home situation, she can have up to $126,000. Now, we have one advantage in New York that other states do not have. We have what's called spousal refusal. And I know sometimes it cuts to the quick to have your community spouse say, I refuse to support my institutionalized spouse. But it's an option that we have so that if the community spouse has more than that $126,000, she can say, I'm not supporting my spouse. Medicaid will automatically pick up the bills for the institutionalized spouse, but then they'll nag the community spouse to set up some kind of a deal to pay them back after the institutionalized spouse passes. I always tell my clients, get an answering machine. When Medicaid representatives call, don't take the call. They're very good at what they do. They're collection agents. And they will get you to turn around and say something that will bind you, because all those calls are recorded, into paying them back. When in effect, because of the spousal refusal, you won't have to pay them back if you play the game properly. Okay, now, one thing that you have to know, that may not be here forever. You know, every time they amend the rules, I always look to see whether they've gotten rid of the spousal refusal, but so far it's held up. Okay, once the institutionalized spouse is qualified for Medicaid, then we can start doing further planning for the community spouse so that if she passes away, we do not want the assets going back to the institutionalized spouse, or guess what? Medicaid's going to say, thank you very much for everything, and your children will get nothing. Okay, so there is a lot of planning that needs to be done. Okay, a little while ago I said, well, we'll talk about transferring assets later. Okay, what you have to remember is that in order to divest yourself of assets, there are several ways you can do it. You can give it outright to your kids. You can give it outright to other family members. But what you have to remember, whenever you give something outright, it's their asset. It doesn't come back to you. And if they have a creditor, their creditor can attach your asset. Creditor doesn't care whether it's really your money. They don't care. They'll attach it. So I'm not such a big fan of an outright transfer. Years ago, we were more apt to do outright transfers because there was only a 3-year look back for outright transfers as opposed to the trust, which is a 5-year look back. Well, now they're all 5-year look backs. So I would recommend doing the asset protection trust as opposed to the outright transfer. Remember that with the spouse, there's no look back period between spouses. So if everything's in husband's name and he's going into the nursing home, you can quick transfer everything to the spouse, the community spouse, and there'll be no look back period. So it will not disqualify him from Medicaid. But if you transfer to the children and he tries to apply for Medicaid, it will result in a disqualification period. You don't want to have that happen. The other thing that I always tell people, that if you are getting older, like if you're in your 60s, and I'm hitting there this year, so I don't think that's old, okay? But if you're in your 60s and you think you're going to stay in this home for a good period of time, there may not be a reason why you wouldn't transfer it to the Asset Protection Trust and get the 5-year clock running. You could always do that. You still have full control. Most people say, oh my God, that means my kid is the trustee of my own house. They cannot kick you out of your house. You have the right to sell your home. And in fact, if you sell your home while it's in the Asset Protection Trust, you still qualify for the primary residence exclusion. Okay, remember, the married couple can shelter $500,000 worth of gains, single person $250,000, as long as you live last 2 out of the 5 years in that home. You can do that. One other thing to note, if you're in a nursing home, that's not considered, it's not considered your permanent residence. So you don't have to worry about violating the 2 out of 5 year rule because you're in the nursing home for 3 years. They don't consider that part of not being a primary residence. So by transferring your house into the Asset Protection Trust, you've done several things. You've protected yourself from anybody else's creditors, because those trusts are spendthrift, which means nobody can put a lien against it. You've also kept your primary residence exclusion. If you have exemptions on your property taxes, you keep that as well. And the best part about it is you can tell the trustee, okay, you know what? I'm tired of all the stairs. I want to sell my house and buy a 1-level condo. And if the trustee says, well, Mom, no, you can say, okay, you're out. You can remove the trustee and put somebody else in. So even though that Asset Protection Trust is irrevocable, you still get to control the direction of your home, where it goes, and you also get to control where you live, and you also get to control the trustee with respect to the house. Most of these trusts, some will give income to you during your lifetime up until the point where you have to go into a nursing home. Then the income stream is cut. Principal can never go back to you. So if you wanted to redo your kitchen, you would have to make a distribution from the trust, not you, but the trustee would have to make a distribution to one of your other children who would pay the bill for you. Or the trust itself could pay the bill because it is a trust asset. Okay? You may not, however, access the principal in any way. Now, sometimes people get scared about that, which is why I always tell people, at least put the house in. We could always talk about your other assets later, but at least put the house in and protect that. For most people, the house is a very large portion of their estate. We may not have estate tax worries anymore, with $11.4 million being the applicable exclusion, but we will always have the long-term care worries. Other options for you. Let's say we put the house in, but I don't want to transfer my stock and bond portfolio. Again, remember, retirement assets we never put into that trust because those are income assets and we don't want to cause immediate taxation. So we put the other assets on hold. If you have a long-term care insurance policy, that gives us the ability and the flexibility to transfer those assets in, because it gives us the ability to private pay for the 5-year look back. So there's different types of policies. The one that everybody knows about is the one that you pay for it, and if you use it, great. If you don't, it's kind of like renter's insurance or car insurance. You have to have it, but it doesn't, you're not using it. Okay, those premiums are gone. You never get the money back unless you end up needing long-term care, and then they pay a certain amount per day. That's one type of policy. Another type of policy acts as a rider to a life insurance contract that can be owned by that asset protection trust, and the rider can be accessed to private pay for the nursing home until the 5-year look-back is over. While the policy is paying for the nursing home, we're going to put all your other assets in, which circles me back again to, we need that general power of attorney with the special gifts rider, so that if you can't do it, your donee of the power can do it for you. The third type is what's called a Care Choice 1 policy. Now that type of policy is where you put a chunk of money in today, and it will pay you long-term care. But if you don't use it for long-term care, your family gets a death benefit. So you don't lose the monies that you're putting in. I like option B and C, because if I don't ever need long-term care, at least my family is getting another benefit. But if I need it, it's there for me. Now, let's go back a little bit and talk about those retirement assets, okay? Because retirement assets, a lot of us have retirement assets. You know, when we retire, and by the way, Sabu, I am retiring next year, just to let you know, so, all right? But when I do retire, I'm gonna have all of my retirement assets in my IRA account. Now, IRAs in New York are creditor protected, so we're okay there. But I'll have to take required distributions from my IRA account. Planning for those assets are very different from planning for your wills, your trusts. You need to name beneficiaries of the retirement assets. They also bypass the probate process, so it is not governed by your will unless you don't have a beneficiary named. So everyone, when you go home, you need to make sure that you have beneficiaries named on your retirement assets. Here's why. If you do not have a beneficiary named on your retirement asset, the default on 99.9% of the institutions out there is your estate. If your estate is the beneficiary of your IRA, estates are not a natural person. They do not have a life expectancy, and therefore every penny has to come out of your IRA the calendar year following death. You don't want that to happen. If you have a named beneficiary, they can stretch it. And if you were in long-term care, Medicaid can't come after it. It's not a probate asset. So you can at least make sure that your retirement asset is there for your family. And again, they can stretch it, meaning they can take distributions over their life expectancy as opposed to in 1 year. Okay, now, Sabu does a lot of this retirement planning. In fact, he does majority retirement planning, I think, although he does also handle the long-term care policies as well. If you have any further questions regarding the policies or the retirement planning and what we can do to help you, you need to talk to Sabu. So Sabu, you want to come up?
Trust, irrevocable trust, and how you can protect your asset and everything. Regarding to retirement planning, I think when they are going to talk about the tax planning, they are going to talk about retirement planning. But I want to give you some ideas, because in the retirement planning, everybody is eligible to put a $19,000 in their 401k or a 403b, whatever it is, and they can also catch up if they are 50 and above, 50 and up. and they can put another $5,000, $6,000 also. So that is the way you can deduct that money from the tax. So then your tax payment can be reduced. That is one of the important planning a lot of people are doing. The other one is like when you retire. So a lot of people are, I see a couple of people here, they are retiring mode or they are retired. And when you retire, your 401k and 403b or a 457, whatever you name it. So when you have that chunk of money, there is a lot of different options you can roll over. There is a different strategy regarding to how you protect that asset from your Medicare and Medicaid issue, and how you protect from creditors. There is a lot of options are also available. That is a very detailed subject, but I brought a couple of files. This is included all the details about what is the trust, how you can make a will, and how you can take care of your retirement account and everything. So already you put the names and everything. I only brought only 5 pieces of this file. So I'll give you a couple of people, and everything else we can mail to you. The reason, like I said before, this is not the sales or anything here. What we are trying to do, because I work with our community last 21 years, I see a lot of people, how they struggle at the time of their Medicare and long-term care issues. So I see the Susan help a lot of people directly from our community, how they can plan everything. So like a 5-year backup period is a very important factor, because all our people, they make a very decent money in our community. So you have to be careful how you protect that asset to next generation. Otherwise it won't make any sense, because I always tell people, when you make a money, your retirement account and everything, you are not going to spend all the money in your lifetime. At least 50 to 60% of the money is going to transfer to next generation. There is no doubt about it. But if you plan in a proper way, in a systematic way, you can, instead of giving a $1 to them, you can give a $2 to the next generation with a very tax efficient way. That is the strategy we always use. So that is the way you can get rid of some tax issues also in your life. That is the most important. But as per the John Verghese, we don't want to hold the question answer right now. So we will do the question. I know you have this is not easy subject, like it is a very, very complicated, very delicate subject. We have a lot of questions, and we know that. But whatever we present, the Susan present here, that is on a general idea. But it has to fit personal need basis. That is the way it is going to work out. When you ask the question, and we can give you the answer how you can fit for your own need basis. So that's the way we are holding that question and answer. Susan, it's okay? Okay, so I would like to invite John Verghese, Dr. Thomas Matthew. He is our ECHO chairman, for introduce our ECHO and our events.
Thank you, Sabu. I won't take too many minutes before the next speaker. Just wanted to update on ECHO. This is the 4th time ECHO is hosting the tax seminar, and as always, Susan has been so much helpful to present it to our audience. Thank you, Susan, for that. ECHO, as you all know, is a silent organization working in harmoniously with the community to help our community for the betterment of themselves. An update which I just wanted to give to this audience is the $100,000 which we collected for Kerala Flood Relief Fund has been in discussion with the Rotary Club International, who has agreed to double the amount. We have a 80 houses project which is being identified in Kottayam, Alapi, Pathanamthitta districts by Rotary Governor Mr. Luke in Kottayam. He's one of the Rotary. There are two Rotary governors in Kerala. One of them is Mr. Luke. With the help of Rotary International, has been submitted to International Rotary for their approval for the international fund. So during the process, it's going to take probably another month before we get to finalize the project. And once that is done, we'll probably be able to announce it. I know it's taking a long time. It is because of the ground facts in Kerala, but it is there. It is been working on, and we are hopeful that probably in another 2 or 3 months we'll be able to make a final decision, and hopefully we can have the rebuilding process finished by the end of 2019. As always, we have our student SAT seminar coming up, and the medical camp fair, which will also happen in the month of May or June. With that said, about the activities of ECHO, I invite Mr. Vinod Abraham, CPA, for the next presentation. Thank you very much.
How many of you filed a tax return for the 2018? 2018 means which you're filing now. How many of you sitting here filed the returns? One. Pastor is an excellent organization. Anyway, pardon me? I just want to go over the impact of TCGA. TCGA means a tax cut and job act of 2017. 2017, December 22, the President signed into law the most overhauling changes in the tax code since Tax Reform Act of 1986. It affects every part of the moving economy, individuals and businesses across the spectrum of the universe. One of the most important thing, how many of you like to get a more refund or a pay less taxes? Who like to pay less tax or one more refund? Everyone. No, it's two options. One option. Who want to pay less tax or more refund?
Less tax.
Less tax. Yeah, but most of you sitting here will be disappointed by the time you file the return. So you're going to get less tax, less refund. But if you are paying taxes, normally you end up paying less tax. So most of you are here in the working community, so they're expecting a refund, but you have to have a less expectation of the refund when you go and file the returns. We'll go to the why you going to have this impact in the if you look at the tax impact, the tax between 2017 and 2018 tax rate. 2017, you have a 7 tax bracket. Same thing 2018. Overall tax rate changed only 2.6 rate. If you look at the media, portrays like one of the worst, especially in the blue state like New York, California, New Jersey, across this kind of state, because we have high state and local income taxes. But if nobody mentioning about the impact, they only mention 2.6, they only benefit the rich people. But when you look at when you go and file the returns, you just compare the both years. How much you actually paid it. For example, last year was 10% or up to 9,525, and this year also the same thing, up to 9,325 if you are lower bracket, 10%. And if you go to the next bracket, the 2017 was 15, and nobody mentioning about the 12% bracket. And 12% bracket is almost covering 9,325 to 37,950. So that itself you have a saving of 3%. That most of you affected by the rate, 3%. And if you go to the next one, the 2017 was 25. from 15 to 25, almost 10. And if you look at the TCJA, it's only 22%. So that covers 77,000 to 165,000. Most of you sitting here cover in that range, which you save almost 3% bracket, tax bracket, 3 plus 2 on the previous. So most of you affect within that range. If you are in that range, most of you sitting here will have been in the 22% bracket, the highest. You save 5%. And if you really look in that, when you have to find the return and you really spend a little time, don't get upset with that, your accountant, your tax preparer, please look how much you paid compared to 17 and 18. So, and if you go higher and higher, and you, of course, the rich people get to save more money, there's no question on that. Every step of the way, people save money on that thing. And this will change, and by every year, because normally we usually have a personal exemption. And now the TCJA eliminated the personal exemption. Now we have only one. Personal exemption is $12,000, or if you are single, it's $12,000. If you are married, $24,000. 12. If you don't get a personal, sorry, if you don't get a personal exemption, only standard exemption. 12 single and 24 if you are married filing jointly. In between, you might enjoy a lot of benefit like state and local SALT, so state and local income tax deduction. Now they cap to $10,000. If you are a New York City resident, you pay state income tax, city tax, and plus property tax, which average comes around $15,000 to $20,000 minimum. You don't get that, you only get 10%, $10,000. Mortgage, if you look at the mortgage cap to $750 if you have a new if you have a house you bought after passing into law, which is only $750,000. But if you are existing mortgage holder, prior to this law, signed into law, you still can have to $1 million. And charity also, there is not much change for the average people because they allow up to 60% of your adjusted gross income, so it's most of your people don't affect it. And miscellaneous deduction, 2%. There is no more job expense. Most of you normally itemize with the uniforms and all expenses, no longer applicable for federal purpose, but still applicable for the state purpose. State will accept all these things. Sold property tax allow and miscellaneous deduction also allow. But if you add up all these things, you might have a big deduction. Now you don't have the big deduction, but instead of big deduction, you're going to see a lower bracket, which you end up paying less tax. And the refund, why the refund is low? Not because the tax low, because if you look at since March 2018, when they changed the withholding tax, they start getting more paycheck, average $50 to $100 every paycheck. If you're working in the range of most of the minimum $50 to $100 every bi-weekly paycheck. You already got the refund before. The issue here is, when you start the work 25 years ago, 20 years ago, you have 3 children, and you are lower income, and continue without change, you never change the withholding allowance, you have a serious problem. That means you got a lot of money back bi-weekly payroll during the last 2018. Sometime you may end paying taxes unless you changed it last year. In my case, so far I did it, so a lot of people haven't changed the withholding allowance reflecting the true status. And one more thing I will mention, then I'll get to Babu. He will go over the remaining stuff. The family child tax credit. One of the advantages of the current TCJ is that those who have children under 17, you get a $2,000 per child. Before, most of our community never benefited because previously it was only $1,000, and most of the community sitting either in a hospital or MDA combined income is more than close to $150 without overtime. So now most of them never received that $1,000 child tax credit. Now, with the new law, if you are making up to $400,000 married filing jointly, and if you are single, $200,000, or any other status, $200,000, you still be able to get $2,000 per child. So that's one of the most significant changes which is beneficial for our community. And if you don't have it, your children will get benefit of that. All these are temporary up until 2025. So, Babu, can you see that?
No. Thank you, Vinod. So as Vinod just said, the Tax Cut and Jobs Act. This is the most comprehensive and most detailed tax change they did since 1986. It affects if you are a personal tax filing, business tax filing, everything has completely rechanged, right? Now, like Vinod said, the most controversial item everybody knew that was in the media when they passed this law on December 14, 2017. Most of you, especially the people who have been living in Long Island, you all pay a skyrocketing, maybe second in the nation, the property tax. Plus, if you're working in the New York State tax and all that comes up to maybe 20,000 deduction, you used to take that deduction as a deduction from your income. That's capped at $10,000 now. Now, there are certain things what you can do here. Doesn't apply to everybody. If it doesn't apply to you, maybe some of your friends or someone who you may know may be able to help. This 10,000, there is a way that you can do some planning here. I hope Vinod will also agree with me that. Say someone who have an LLC, a subchapter, S corporation, he may have a retail store. Okay? If you think of it's a retail store and it's practically impossible to do all the admin work of the business, so you may want to consider having a home office to do all the paying all the bills of your business, placing orders and all that. Dedicate a small part of your home as a home office to run your business. If you do that, what will happen? Can we take a part of the property tax as a business expense and deduct? You may be able to, if you can establish this. That's number one. Number two, some of you may have, or you may know, some people buy land and keep it to build a house or something. I know people have, they buy land in Florida and keep it, and they pay tax on that. You take that also as a property deduction on your tax return. There is something specifically in the law, in the tax code. It says section 266 says unimproved land. If you pay tax on the unimproved land, you don't have to take that deduction because it's capped at $10,000. It's not going to help you anyway. So what you can do, something called you can capitalize that. So you have to make an election, tell your tax preparer or CPA, I want to make it section 266 election. What that means, say you bought that land in Florida for $100,000 and you paying every year say $4,000 property tax. So this year, Babu is making section 266 election on that land. Next year, my property's book value will be $104,000. So I do that every year until this law. By the way, this law is by temporary. They passed only for till 2025. Most of them are temporary. So after that, I don't know why they made it till 2025. I hope maybe the Republicans expect to win the next term. Maybe I don't know.
They want to see how it impacts the deficit.
Deficit, okay. Probably that's why. Or I don't know if the Democrats come, maybe they can scrap some of it, I'm not sure.
No,
The mortgage interest deduction, right? Any mortgage that you took prior to December 15th, 2017 is grandfathered, no problem. Up to $1 million, you can still deduct. Anything after December 14, 2017, the maximum mortgage interest I can deduct is limited to $750,000. Now, Bob, you have a mortgage, $500,000 mortgage. I want to improve my business. Okay, so I'm refinancing my home. If I refinance my home after in 2018, take additional money to run my business, can I deduct that interest? Yes, you can. There is something called Section 10T. You tell your accountant you want to select Section 10T traceable deduction. If you do that, you can deduct the refinance mortgage interest on your business as your business expenses. So there are some options here, even though the law is, certain things they reduced it, you have.
And also the home mortgage line of credit. Now, based on the new law, it is not technically allowed it. But if you can show that you really use it for the business, improvement, or just like Babu said about the business, you still be able to deduct either on the personal tax return or your business tax return. So it's still valid if you can prove that if you use it for the finance, improving your house.
Yeah, some of the items that they, when this TCJ, they call it TCJ, passed, some of them survived some of the items. Some of the items is thriving. One of the examples is the charitable contribution. Charitable contribution, they increased to 60% of your income.
Yes,
From
that means if some of the people in our community pay a lot of money to a charitable organization. For example, if your AGR, adjusted gross income, is $100,000, before technically up to 50,000 you can deduct the same year, the rest you carry forward. Now they increase to 60%. That means 60,000 you can do in the same year and carry forward the next year.
Yeah. Now, as Vinod mentioned, they increased the standard deduction to $24,000. So most of the families may not get any benefit of their mortgage interest and property tax on all that. 24 if you take the standard deduction.
Yes, but our community benefit proportionately higher than the national average.
Correct. Now, there is something you may want to think very carefully and plan this. Say, you may want to take a paper and pencil, and before the year end, I mean, it's too early now. I mean, for next year you can plan it. You may want to take a paper and pencil by sometime December and put it down how much is mortgage interest you pay, how much is your property tax, and that's only $10,000 in here. First you put $10,000, property tax and mortgage, okay, it comes around maybe 18,000 or 19,000 or 20,000. We know that our community is very generous. They all donate to the church a lot, no problem. Say if I give to my church or my temple maybe $3,000 every year, you may want to consider in December, every year I am giving $3,000. I may want to consider giving $6,000 for the 2 years in 1 year, if it bring me above the $24,000. Are you following me? If you do that, maybe you may be able to take advantage of the charitable contributions that you combine for 2 years together, add with your other deductions. If it comes over $24,000, you may want to plan that.
Yeah, keeping on that aspect, one more other things I want to mention to you. And our community is the first generation coming is almost in the baby boomers retirement age. Now what happened, they inherited they saved a lot of in the 401k and 403 or 457. So on the top, they have, if you work in MGA and you work 30 years, your salary is more than what you're going to make in your pension with Social Security. So you don't need to add more money to a taxable income. If you are a charitable person, what you can do is, you can take the money directly to an organization you support. For example, if you are a member of a church or a temple or a mosque, what you can tell them, you can directly forward the money from the, mostly I'm talking about the minimum required distribution, MRD, minimum required distribution. So you can move that money without affecting increasing the tax bracket. You can have a charitable reduction, and also your income don't go up.
Another change they made in the TCGA, I don't know if some of you might have, sometimes people take a loan from your 401k or retirement plan if you are in need of money, and you are supposed to repay that over a certain period of time. What happens if you take a loan and your job got terminated? Okay. In that situation, you are not able to repay you still can repay the loan, and if you are unable to repay, and if the year end is over, and you're going to get a form 1099 from the 401k plan administrator, and that's considered, the unpaid part is considered as a deemed distribution, which is subject to tax, and unfortunately, if you are less than 59.5, it's subject to an additional 10% penalty. That's very devastating. Under the new tax code, they gave you some additional flexibility. If you lose your job or if something happens, and if you have a loan repayment pending, they gave you time till you file the tax return to make your rollover to another plan. It's something flexibility that you can, before December 31st, you don't have to bring the money and pay, otherwise you have to pay the tax.
So another thing I want to mention about the 529 plan. A lot of our people not aware of that 529 plan. It's called a New York 529 plan. One of the best plan, and if you'd have, you can save money without paying taxes. We can use it tax deferred, and if you use it for the college tuition, you don't need to pay any tax for the deferred. And if you start early, you can start anytime. If you have no children, if you have grandchildren, you can do it for grandchildren. And they're one of the best plan for the college service. Now they made it so much better. Now you can use this money even from kindergarten to all the way up to 12th grade. Not only for the secondary, primary, secondary, and post-secondary. So every year you can $10,000. You can use it for if your children go into private school, and you can use it. So the money sitting in the bank, you earn the interest, or you pay tax on that. Now money moving to 529, not only get a New York State deduction of up to $10,000, and it grow tax free until they take it. And if they take it for distribution for the purpose of education, you never need to pay any tax on that thing. And also you can use it from kindergarten all the way up to 12th grade. That's one of the additions they did.
Another change in the new tax law which is bad, I know most of our community people, they open an account in the child's name and keep some money or make some investment there, keep it there. Unfortunately, under the TCJ, what they going to do, if you have a child and you keeping investment under your child's name, any income generated from that is taxed at the maximum trust tax rate, which is 37%. So, if any of you doing that, I mean, why would you do that? I mean, your tax rate may be maybe 20% or 25%. Why would you keep your children and pay 30% tax bracket? That's shooting yourself, you know. So, if anybody of you have that, you may want to consider either changing that investment to your name. Alternatively, you can, if the child have enough income, more than the standard deduction, consider having your child file a tax return himself and exclude from as a dependent from your tax return. So filing a tax return himself, maybe give me a lower tax bracket. So please do not keep a child's investment in child's name.
I believe they can earn up to 12,500 with the zero tax.
Zero tax, exactly.
Yeah.
That's why if they file a tax return,
If they have too much money, don't do
exactly.
it. You're going to ruin your tax.
Exactly.
Up
No,
to
this right.
12,500, it tax.
Zero tax.
Yes.
And remove them, from your child as a dependent, and then you're good.
Yes. And also, if you have a dependent like your parents, a good thing, even though you don't have a personal exemption, you still are entitled to a $500 credit. Each dependent on a tax return over 17 years, they will get a $500 each from the federal government. And also, still the state you can allow to get the reduction either also.
Right. Any of you have your own business like LLC, subchapters, corporation, or any of those?
Dr. Matthew, at least.
I don't know if you qualify the QBI because.
Yes, in general, we never covered the business because most of you sitting here are working class, the group, not class, but working group. Those who are, if you are anybody in a business, they also benefited by TCJA. That we have up to 20% of the income is a broad calculation. We are not going to go to the calculation side. You are excluded from your income. For example, there is an exception for that too. A few other people, something like is doctors, lawyers, engineers, architect. Architect is an exception. That is some exception he made because he's in a construction guy. We are not covered, but even though we are not covered, we still be beneficial if you are not making too much money. Up to $315,000 if you are married. If you are single, $157,000. If you are in the range and you start phasing out $50,000 more for the single person and $100,000 more for the married person, you are eligible for 20% of your business income through this concept called QBI, Qualified Business Income Deduction. And it's a broad calculation, and that's a great impact because in a corporate tax rate change to 21%. So they come up with some kind of temporary fix to make it a flow through. Because if you look at the United States, small businesses, they are the main driver of this economy. So they also want to make par with the corporation, even though it's a temporary fix. You want to add?
Yeah, so the corporate tax, just want to add what Vinod said, from 35 to 21%, and the United States is the second lowest corporate tax in the world now. Okay, they want to bring more capital here, thrive, evolve more small business and everything. That's why they decreased this, they are giving this additional 20% on the small business as additional qualified business income. And doesn't apply. If your income is less than $350,000, it's up everybody, even if you're a doctor, engineer, doesn't matter, you get that deduction. Another major important changes which everybody knew that probably some of you in this room may be subject to something called AMT, alternative minimum tax. They made a very big change to the AMT and the exemption amount. There is everybody know what is AMT, by the way. We just these are accountants' name we are talking about.
Alternative minimum tax.
The AMT is something I think in the early 70s about the Treasury Department found out like around more than 100,000 people, I believe.
More than 40,000 people.
40,000 people, they were making over $250,000 those days, paid zero tax those days. So they called the congressman, they called so many people for hearing and everything, had to come up with something. What is this? Everybody's not paying tax. I mean, people make $250,000, those days could be like a few millions today, and paying zero tax. They didn't do anything. They didn't do anything wrong. Everything go by book. They took all the loopholes in whatever is the tax law says, and that's what they did. Their account was so good, so they didn't pay any tax. So they came up with this law. They called accountants, they called actuaries, they called economists. Everybody come up with something, guys. So they came up with okay. When you take, we have so many deductions allowed: mortgage interest, property tax, this, that, everything, job-related expense, previously, all that. When you do that, they have a parallel calculation. Some of you know that, when we file the tax, there is a line item comes up, alternative minimum tax, an additional tax. If you make a certain amount of money, you have to pay minimum tax. That's called alternative minimum tax. So they enacted this, but never adjusted with inflation or any other changes. So they made a change with this TCJA also. The exemption amount increased it to $104,000.
Yes.
And the phase out will start only after $1 million.
Yes.
So this is a major thing. Anybody who makes like, high income group will not see, most of the people will not see any more alternative minimum tax.
Yeah, the good news is most of our community don't see the AMT. If you look at last year,
which is
you
a
all
big-
have the AMT.
Which is a
of them.
positive thing.
One other the tax planning which Sabu mentioned that, a lot of people ask you, how can I save money? How can I pay less tax? And if you ask one question, they ask him, are you maximizing 401k? No. That's most of them don't even think about it. They don't want to hear that part. They want to pay less tax, but they want to one of the most important vehicle for an employee to save money is for 401k or 403 or 457. And some of the employees who work, and some of the individuals who work here, they have blessing to have a two pension plan. If you work in MTA, some of the hospital, they have 403 and some 403, 401, and over 457 and 401. So they don't even use any of those things. So one of the drawback, if the children growing when they reach age of in the 40s, their children going to start going to college. When they go to college, they missing the biggest credit. They're going to get a free money, $2,500 credit for the college for the first 4 years. Most of them don't hit it because of they're not having good planning. Why? They are not putting any money in the 401k. If you do, most of the people I am seeing in our community, if they do maximum, they all get this free money, $2,500. And all of them, most of them I would say, they're missing this one because they don't have enough planning. They are not putting enough contribution to 401 or 403. I strongly recommend all of you, if you look at your pay stub and make sure you do enough to cover 19,000. If you are over 50, make sure you do catch up for $6,000. This is never going to come automatically. Make sure that you look at the pay stub. You have 26, most of you have bi-weekly, only 26 pay period. And if you have a deduction of $400, so that means you're going to have only $8,000. So you need to increase it to reflect the remaining pay period to come up with the total. The good thing of this, in the New York State, this is taxable. But the beauty of this one, when you defer it, you don't pay state and city tax. When you take this money, each individual, husband and wife, both are entitled to get 20,000 tax free. So you growing the money without paying tax. When you take the money in the New York, you don't pay up to $20,000 state and city tax. That's one of the beautiful tax planning you can have, especially if you are in New York City, because they pay 3 taxes.
Another most important thing which we have in the accountant community has been for a while, trying to convince the community about disclosing and reporting your foreign bank. The United States tax system is one of that kind called you have to report worldwide income. So if I have a farm back home, if I have a coconut tree back home, and if I get coconut from that and sell it and get the money, tax law says I'm supposed to report that to my US tax return. That's how the law is very clear. Also, the law is there, and if you have a foreign bank account and if you have more than $10,000 at any time during the previous year, you're supposed to disclose that on your tax return. And this is very important. Everybody, when the community people come and do the tax return, we ask the question, do you have it? Then they look at me, or, I don't know if you also, what it has to do with you. We don't want to know. Honestly, we don't want to know. We don't want to know none of your, personal matter, but it is very important. Well, then they come up with, they're trying to be smart and they say, oh, well, they're not going to find out. The Treasury Department is going to find out. Guess what? When this law started, when did they start this? 2003 October, when they started this law, I myself thought also how the Treasury Department is going to find out if Babu Uttaman have a bank account in India, how they're going to find out. Then we were waiting and watching how the law is unfolding. In the subsequent years, they came up with something called the FATCA, Foreign Tax Compliance Act. What does that mean? Any bank under the FATCA, if any foreign banks wants to deal with the US banks, that country has to sign into the FATCA. Okay? And the government of India signed that.
Yes.
It's
Almost 85 countries are signing to that.
Signing into that FATCA. That means eventually all these and practically those who are in the banking field would know, practically impossible for any bank not to do business with the US bank, because as long as the US dollars is the international currency for trading and everything, they have to deal with one of the US bank at any point, okay? And they cannot do that unless that country signed a FATCA. So every country is signing FATCA. And you will know if you go and want to open up a bank account, and if you happens to be a foreign citizen in any other foreign country, you will see how much paperwork you need to do. Okay? There are so many requirements. So eventually, all these banks go into report if you have an account, and the Treasury would know. And when they look at your tax return, if it's not there, what I call, you will get a love letter from the Department of Treasury.
Yeah, eventually. They already started reporting, but it takes time to get in the system, reconciliation with the Department of Justice, and it's a matter of time. But people need to understand it. Yes, you may have a NRO account, which you may not even update your bank account data. So they still think you are a resident of India. When you left the country, you used to be having an account called NR resident account. Resident account is not subject to US reporting because they think you are not a foreign national. So assuming that the bank never ask you the new update and Social Security and all those things, what happens if you have money, eventually you want to take the money. If you want to take the money, you want to bring it here. When you bring it here, their banker see you might deposit some money. It is not called unusual. This is called unusual transaction. They are not going to let you know. They're going to report to Department of Justice. So now, Department of Justice, they do their own artificial data analysis, and if they think that when they look at when they match with the tax return, your income do not support this money coming in, then you may be subject to an audit. When you send your audit notice, what they ask you, any audit, W2 audit, they ask you bank statements. When the auditor analyzes a bank account, what they see the money coming into this account. They only say why. So now, at that point, the issue becomes not a civil, that's a criminal offense. So they need to hire an attorney. When you hire an attorney, they're going to charge you, anything with a bar attorney, they're going to charge you more speedier than your heartbeat. So that will be a very challenging issue. So basically, some of you, I'm not trying to scare all of you. Some of you may know somebody, you might have to tell them, listen, this might be an issue. You might start reporting this one, at least you don't get in trouble.
I think we pretty much covered everything for today's session.
Yes. If you have any questions, you can ask.
Next, we want to open the time for the question and answer.
It's tax return. But everybody subject is called a 1040 Schedule B. Almost all of you fill out this form. On the bottom, there's a question there, line 7A. At any time during 2018, did you have a financial interest or signature authority over a financial account, such as bank account, securities account, brokerage account located in a foreign country? See instruction for details. You have two options. You put yes or no. If you have one account, if you put a no, that's a criminal offense. They catch you. And if you put yes, the next question, if yes, are you required to file FinCEN form 114? That's exactly Babu mentioned. FinCEN is Financial Crimes Enforcement. There's a form called 114. See, if you have more than $10,000 in any given point from January to December, you might have deposited $100,000 in one side and the next day is only zero, but that means you are subject to FinCEN report. So you have to file called FinCEN 114, and you have to mention next question is which country you're from. Is in our case, most of the case, India. So you have to mention the name of the country too. So that's the difference. It all boils down from the tax return. Very simple tax return. You file it for all these years, and people brush off. Some accountants ask it, some actually don't care about it. In my office, I ask everybody same thing. Babu, same thing. When they come, they have a phone account. Most of them say no, some of them say yes. Then they're going to take more questions.
Okay, my question is, if I have some money in India, I am paying taxes. So how will I adjust taxes from US?
You will, this is a double tax. There's no double tax. It's a credit, you'll get credit here in the United States. But you need to disclose here, you get paid tax, you calculate as if it's a US income, then there's a calculation called credit for the taxes you paid.
But we have Indian money, we pay taxes for that money. How can we convert into this tax system?
That's not, our accountants do that for you. You are not converting, you are disclosing that you have this much money in your account. IRS don't care about the money you have. They don't need to worry about that party. Your job is to disclose how much money you have in Indian account.
But next question about the will. Once we prepared a will, prepared by an attorney, whether we have to register that thing anywhere in the county office?
No.
No?
You're not required to register. You're not required to file your will anywhere. Okay, so no, you do not have to register it. But you should take a look at it, at least once a year to make sure it still comports with what you plan.
Thank you.
This 10,000 in foreign account, it's only in the case of a bank account, or if we have paid for a construction of a flat or an apartment. That's not in my name, but will that be considered for this?
If you send the money to a third party, I don't think, if you have no bank account, it didn't go through a bank? Did the money go through a bank?
No,
You send it to a builder?
yes,
Then I don't think you are not subject to the
Putting the
FBAR.
accounts in your name,
Yeah.
it's not really bank, it's the law says depository account, meaning bank account, brokerage account,
Yes.
insurance,
Yes.
and what else you have there?
Medicaid has a 5-year look back. So if we transfer today, then we really can't apply for Medicaid until 2024, because then we'd be beyond the 5-year look back. If you have to apply prior to the 5-year look back is expired, then we kind of have to look to see what we can do to get you beyond the 5-year look back. Okay, we might have to private pay, say there's only 2 more months left. We're gonna private pay for 2 months to get you beyond the 5-year look back, because if you violate the 5-year rule, Medicaid will disqualify you from receiving Medicaid, and the period of disqualification begins when you apply for Medicaid. So I'd rather pay 2 months private pay, get me beyond the 5-year look back, where I don't have to disclose anything to Medicaid, as opposed to applying right then and there and then ending up with a disqualification period that may be for another 5 years, depending upon the dollar amount of the assets you transfer. So the goal is to get beyond the 5 years.
Susan, one question I have is,
And parent to own, okay? They can put the money into it, but I'd rather them not own it, because Medicaid does consider a 529 plan an available asset.
so they can put the children's name as a
As the owner, correct.
Yeah. Yeah, most of the people work in our community is working in government. They retired, their income is not subject to state taxes anyway, so really they don't get the benefit. Most of them don't get the benefit if they are retired. So I tell them to put the children's name, and so they get the benefit.
Correct.
In my case, a lot of people I come with, I strongly encourage. Now I didn't know about this concept,
Yep.
but I tell them because they don't get the benefit, so why not you put the money, the children?
But let the kid own it on
Yes,
behalf of the
they fund
grandkid,
it.
yeah.
But there is a
Second
problem.
point.
Financial aid
yeah. Talking about Medicaid, Susan.
Yes.
Susan, when you mention Medicaid, you actually mean only one type of Medicaid here, that is called nursing home Medicaid, right?
No, I also talked about home health care.
And home health care.
Correct.
Whereas you are not referring to the regular community Medicaid or the emergency Medicaid.
Community Medicaid is home health care. It's the same animal, it's just a different title. That's the same, okay? In terms of emergency aid, that's for people who are so impoverished that they don't have the ability to pay for any health insurance. That's a different type of Medicaid, and that you really have no assets to protect to get on that kind of Medicaid, okay? But community Medicaid is home health care. Yes.
Fortunately, somebody ends up in a nursing home, needs Medicaid. We have will or trust, which is better to keep.
Different animal.
It's different, right, it's different. In other words, the revocable trust versus the will is really a probate concept. If you're in a nursing home and you're applying for Medicaid, you're only gonna have 15,000 worth of resources left to distribute, okay? And yes, a will take care of that, no problem, all right? You can do that. But the spouse, I would want this community spouse to have a revocable trust, because God forbid she passes away, I don't want anything going into probate. You have to remember, in New York, you're responsible for your spouse's medical expenses. So if your spouse passes away, all those doctor bills you're getting, they first try to get them from the estate, but then spouses are responsible for those. We're not responsible for each other's credit card debt, but we are responsible for medical expenses.
Clarification, I didn't understand clearly, is the home health care. The amount you have for single and for couples.
Right.
That's the minimum amount, and you said you can transfer the
The
other
excess,
assets.
right. So
Can
what
you clarify that
happens
one more?
is the minimal income, or the maximum income, I should say. The maximum income for an individual is, what did I say, 800, and they just raised it, so it was 842, now I think it's up to 859, but is 800 and change. Any income that's above that maximum has to go into the community trust, or the pooled income trust, as they're also known, or else you won't qualify for Medicaid. Okay, and the same thing with the married couple. Okay, if you go above the 1267, it's got to go into that trust.
So if you need it for temporary, like for a year or so, and if you start putting it into the community fund, will that continuously go up?
Well, this isn't like Medicaid because you're impoverished. This is because you have long-term care needs. You don't get better from long-term care needs. This is not temporary disability. This is permanent. This is long-term care, chronic care. You are never going to recover. Okay? You are too far down the road, medically speaking.
No.
So my question is about irrevocable and revocable trust. What are the significant differences between these two? And with regard to irrevocable trust, right? How is it different from revocable trust?
Okay. A revocable trust is one in which you can make changes to at any time. The whole purpose of a revocable trust is to avoid probate. You don't, with an irrevocable trust, you're giving away your assets. So for tax purposes, you're giving away the assets. You don't control them anymore. But the revocable trust, it's as if you still own them yourself. And for Medicaid purposes, a revocable trust is only good for the community spouse. You having a revocable trust does not protect any of your assets from Medicaid's reach. Only an irrevocable trust would do that, and asset protection trusts are irrevocable.
Detailed discussion about the will, trust, and tax planning. So somebody asked what is the difference between will and trust and everything, right? So the will, it is in a simple way how you want to distribute your asset after your death. That is the will it is going to do. But through the trust, you can change the ownership and you can take a lot of decision and you can set aside your asset from your own name to an entity name, right? That is the trust do a lot of times, especially the irrevocable trust. That is the way you can save some money from all the long-term care and all those expense and creditors. That is why we sincerely advise the people, especially in our community. We always tell them to make an irrevocable trust and move your property and everything. The reason is, a lot of people, they are trying to say, okay, I will change all this name to your kid's name. Let's say, God forbid, somebody sue your kids for any reason. Your asset is liable. If they divorce, your asset is liable. They can force you out. We don't want to lose that type of control. That is why we need to have some plan, protect your asset, and keep your mind in a very peaceful way. That is one of the things. I want to add something about the tax planning. So the people can open the 401k, 403b, whatever your employer is sponsoring, and you can put $19,000 plus $6,000 if you are 50 and above. Plus, if you are under the $194,000 or $160,000 income basis, you can also open a Roth IRA. You might heard about Roth IRA. What is the advantage? Because you are putting the money after tax, but whatever the gain you are getting that account, that is a totally tax-free money.
Absolutely.
That is the one of the strategy you can make if you qualify for Roth IRA. The other one is, a lot of people in our community, they are missing the health saving account, HSA account. A lot of people, they don't talk about it. That is the last year I put some money. I forced to pay some money for the medical expense. I saved some money. I put that $3,500. I save almost $1,000 in the tax. That is one of the best investment you can have. This is not a big money, but $1,000 make a lot of sense. So you can open if your employer is allowing you, you can open a HSA account. That money, if you don't use that money, you can transfer to next, let's say at the time of retirement, you need to use that money for Medicare or a Medicaid, you have the option to do that. There is another plan, a lot of employers, they are sponsoring flexible health savings spending account. But that is only drawback is you forced to use that money in that same year. Otherwise, you lose that control of that money. But if your employer is sponsoring a HSA account, please join that one. You can put a $3,500 without any tax. You can use that money to buy your glass or anything. Last time I used for the purchase the glass, I used that money. So that is the way, that is a tax saving money. That is the another way I want to explain to you. There is a lot of things we can work out together. So you can save some money in a tax and everything. That's the
Even the HSA, if they allow, you can do both husband and wife.
Absolutely. So that is almost $7,000 you can save in the tax. That's a good money you can save every year. And at the time of your Medicare and Medicare, whatever it is coming, so that time you can use that money to pay your bill. So it is going to help you. So you don't need to ask for anybody else for the money. That is also most important factor. So I hope anybody has any more question? Anything? Question? No. Okay.
Thank you.
Thank you.
Especially we are in this country, most of them like 30, 40 years, and it applies for us also. So, and I know that you are going to retire to next year, and it
No,
is,
I don't think so.
no, that makes because she planned well. That made her to retire like next year. And we from a part of ECHO, we want to thank you at coming at this time, especially the long weekend. And let's give her a hands up. And yeah. We invite you also, it's open, this organization, whenever you have additional points, things like that, you can come and share with us. We always welcome that. And next, I want to thank Vinod George Abraham for taking his time. Actually, he is like a 24/7. Whenever you call him, he will respond. And he is always busy with the tax and helping other business people or individual tax filers and all. He also scared us that we will be paying more tax because of the less deduction which they took it from the tax this year. In fact, I am a perfect example because our deductions was they took it less, and I was filing my tax return last Sunday, and I like 11 o'clock and 11:30 in the night, I couldn't. My wife was asking, "Are you not sleeping?" I was scratching my head, because looking into that, it showed like I have to pay $8,000, $9,000 tax to the IRS. Oh God! So because I used to play around every year, and this time it came to like $8,000, $9,000. And when I analyzed it, and I saw that like $4,000, $5,000 of the tax deductions was less compared to 17. So I had a peace of mind from there, and also my son turned 18, so I don't have any deductions or exemptions, and I don't get any $2,000. He talked about child credit.
Still you can try.
Yeah, I have to play around with that. Yeah, so I just want to thank Vinod Abraham for coming here, and please give him next, I want to thank Babu Uthaman, and he is a very knowledgeable guy. I know him from how I met him is I went for a CPA course, study course in Beckett Advisor in Manhattan, Pennsylvania Hotel. It was in 2002 or 2003, somewhere around that. And I saw one guy over there, and I thought he may be Guyani or something like that. That's how he was. I was doing that. So I approached him. I went ahead and I approached him, and he said he's from Haripar. So Kerala, and I said, "Where are you?" "From Haripar." So when we talked about him, and he's a first rank holder of MCOM, first rank holder from Kerala University. So he's a very knowledgeable guy. 24/7 he is available, and
he's a CFO or
sorry, Savuka, right?
Yeah.
And he's a CFO of the trading, the Aramex, which they are like FedEx.
Yes.
So he's in charge of US. He's in charge of like 3-4 entities in US, and he also is a practicing tax practitioner. So I just want to thank from ECHO for coming here, taking your time and asking us. And next, I want to thank Sabu Lucas. Sabu Lucas, you know him, and he's a well-known financial planner, and he explained a lot of things about retirement on. And I wish you all the best for the future as well. Can you please give him a hand as well? So I want to thank gentlemen for helping us and taking Shaji, I'm sorry. Shaji, reporter, yeah. So taking his time.
They recently started in US, right? Yes.
Oh, okay, yeah. So I wish everything, all the best from my part of our view. And I just want to thank also Pastor giving us this facility to come organize this. Every year, whenever we want, he will open up the door for us. And he doesn't charge also at that. So, and...
No, he'll charge.
Oh, yeah. And I want to thank all the audience who came here, especially taking the time this long weekend. I know that, and we expected more, but at least by God's grace, you all came here. And I want to thank from ECHO part of you for coming and taking, and also getting on most of the information. And if you have any doubts, things like that, we have an open email address and things like that, or Sabu, or we have a phone number in our flyer. You can contact us, and we will reach them accordingly. And next, we want to thank our president as well. He is always there to help us. And as he mentioned, this is our 4th tax seminar, and we are trying to help our community best. We are hidden. We don't advertise like that, and we have website, and also it's a word of mouth. And what we would say that from your, if you can spread the word, and we can take contributions, things like that, which we help. We don't keep anything. We try to help others, like student financing or dialysis unit back in India, and also this house, things like that. So please spread this the news, and make everyone will help us, and may God bless you all. And being said that, we wish you a long weekend and have a safe trip back. God bless you, and God bless America.
One more thing. I would like to especially thanks to John Varghese. He was the convener for this event, and he did a wonderful job. Give him a big hand, please. And like I said, as a ECHO, we want to be part of our community. We are with you for all the events and everything. If you need any help, please approach us. We are here to help you and work together, and we can make a difference in New York. Thank you very much. Good night, everyone.
करे तुझको भी प्यार हो जाए, रब करे तुझको भी प्यार